Okay, our next speaker is Steve Shatto from Eternal Energy. He's going to talk about general overview of investment opportunities in the energy sector. Steve brings over 25 years of principal investing, banking, and corporate finance experience to growth-oriented clients in the energy industry. He founded a successful consulting practice and serves as the CFO of Crescent Pass Energy, an oil and gas startup focused on developing and operating natural gas resources. Steve has served as managing director of Macquarie's Energy Capital Group, where he directed business development investment opportunities for their over $1 billion upstream and midstream energy capital business. Steve also worked for JP Morgan in energy finance, credit administration, and corporate banking. He has a BBA in finance from Texas A&M University and an MBA from Baylor University, where I sent about $500,000 for 2 kids. So anyway, welcome, Steve.
Thank you, Dan. I appreciate that. And you know, invariably when you've got a conference or a presentation to make, that week you wind up with allergies and wind up being a bit hoarse. So hopefully I can make it through the presentation today without any trouble. It's a pleasure to be here. Thank you, Craig and Tommy and the SGR team for the opportunity to present today. I know it's great being here. It's just nice being here, being out with a group of people. Everybody's reasonably well socially distanced. I know we've got a fair number of people online as well, but it's just good to have a slice of normality again in kind of the world that we live in. I know that there are a number of people that are watching remotely. Welcome, and hopefully you'll get some benefit out of the presentations today. Let me see if I can get this to start. There we go. One of the things that I have, well, let me let you kind of watch the slides here for a minute, because I've got a question to ask you. I'm assuming as some of these are scrolling by, a few of you are starting to look at your agendas and asking, is this the paving contractor presentation? I was going to skip that one. But I want to ask you all, what do these pictures all have in common? Is anything in here that you see that are concrete? What else? Anything else? These are driveway ramps. They're sidewalk ramps. Also, what we know as curb cuts. Curb cuts are actually pretty interesting, and curb cuts help us get from one place to another. They're everywhere. They take us home. They take us to work, school, church, shopping, on trips. They take us from where we are to where we want to be. And they're actually also an investment. They require a plan to be drawn up, submitted for permit approval. Contractors have to be hired, inspections have to be made, and money has to be spent. But what I find most intriguing, I'm a runner, so I'm out in the morning, I'm headed down the road, and I see curb cuts everywhere. And one of the most intriguing things I find about curb cuts is that some of them are just out of place. Something happened, you know, plans changed. And you often are left to wonder why. So here's one where it was working just fine for us, but it's not really doing much for us now, but we want to keep it around because we expect it'll work for us sometime in the future. We put the curb cut in, but you know, we outgrew it. It wasn't quite right. We put the curb cuts in, and you know, it didn't really take us anywhere. We put one in, and someone else came along and just sort of screwed it all up. we designed it, we built it, we installed it, and it was going to be fantastic. But just in the end, didn't do it for us. Sometimes things happen just absolutely beyond our control, and our work and effort and our curb cut, we can't use it anymore. And sometimes they're absolutely fantastic, and we love them and we use them all the time. Where is he going? But did you hear what I said about curb cuts? It was working for us in the past. It may not be right now, but it will again. We built it. But in the end, it wasn't a good fit. It just didn't take us where we wanted to go. Someone or something got in the way. We just got ahead of ourselves. Circumstances beyond our control. And sometimes they're just fantastic. That sounds an awful lot like curb cuts and energy investing have a lot in common. Now I get it, right? My name's Steve Shatto, and as Dan had mentioned, I've been involved in the energy business and investing in, or putting capital to work in the energy business for over 25 years. I am here today with Eternal Energy, and was asked to provide a presentation on a general overview of energy investing opportunities. And as I started working on it, I quickly realized that presentation was going to be a mile wide and an inch deep. So instead of focusing on that, rather than providing a ton of information that you probably already know, what I've decided to do is take a little bit of a different approach. And what I hope to accomplish today is pick up where Pat left off. And I hadn't realized that Pat was going to provide something of a history lesson on where the energy business came from and bring us up to today. But really what I want to talk about is where we are today and talk about the environment in which we operate. Investments in the energy business are, by definition, live in the environment in which they're made. The energy, also want to frame up that environment and talk about the energy business where we operate and identify some of the key trends in the industry. And as an example of how we might approach putting capital to work in the current market environment for both financial investors and also companies. I'm assuming that there's some people in the room that are with energy businesses and are responsible for making capital decisions for those businesses. Hope to give you some ideas as well. And then by way of, or by bringing you into my world a little bit and share some of the companies and the technologies that I've recently had the opportunity to get to know and been able to become familiar with. First, a little bit of context, and so that we're all on the same page. Don't listen to anything I have to say. I might as well go ahead and address the 800-pound gorilla in the living room. We are absolutely in the middle of an unrestrained pandemic at this point. The graph to the left, as you can see, these are new cases and ongoing cases. And as you can tell, it's starting to pick up. These numbers were all pulled here earlier this week. Maybe a silver lining on that cloud, but to the graph to the right indicates the number of deaths that we've had. While bad, it doesn't seem to be turning up yet. And I think that's a bit of good news. But the best news of all is that Pfizer came out just recently announcing their vaccine is 90% effective at preventing COVID. And I think that has really buoyed the markets and given us all quite a bit of hope for the near-term future. But of course, the virus, demand-driven price decline that we've seen with the demand dropping off fairly significantly has dropped oil from what had been in the $60 range into the $40, certainly below 40 for a while, into the 20s, but really more steadily into the $40 bill range. But we've also seen some interesting prices. You may recall that the May contract actually went negative, and something I hadn't seen in my career in finance. But the story on prices is really more than what you see here. And so I've gone back to 20, really this goes back to 2014, because much of what the energy business is still dealing with, and some of the trends that have developed in the business have really come out of the very significant price declines of 2014 and 15. Who remembers $107 oil? I mean, I'd almost forgotten that, and it really wasn't that long ago. And the pressure on upstream service and to some degree midstream and to a lesser degree midstream and downstream companies really started in 14 and 15 to improve balance sheets, improve returns, and start distributing more capital back to investors. And that has been a theme that's been developing over the last several years in the energy business, only accelerated, if you will, here more recently by the price declines in 2020. But an interesting story at the same time have been natural gas prices. And natural gas prices have experienced quite a benefit this year. And so what's driving that? As associated gas production from oil and gas drilling, or from oil drilling, really, primarily and significantly in the Permian, was depressing prices last year and certainly into the early part of this year, as the perception and the expectation that gas will be less available from that source, the associated gas, natural gas prices have improved. And that, I think, is a trend that we will probably continue to see as we move forward, is a stronger natural gas market. But there certainly has been pain for the upstream business. And as in prior price shocks to the industry, the closer you are to the drill bit, the more pain you feel. So the service companies, the producers feel it the most, midstream certainly less, and downstream probably even less than that. It's been a challenging year for producers with 42 bankruptcies, and this is the Haynes and Boone bankruptcy monitor information. With 42 bankruptcies in 19, and all of 19, 40 bankruptcies this year to date. We'll certainly pass 19. 2016, as you can see, it's probably hard for you to see, but really there was a fairly significant jump in 2016. I'm not sure we'll meet those levels, but we'll probably get very close. With $25 billion in 2019, last year, $25 billion of debt investments were wound up in the bankruptcy court or being litigated in the bankruptcy court. This year, $53 billion, $25 billion last year, and again, year to date through September, $53 billion so far this year. So it has been a significant year. But I think one of the things to note in here is that the pain isn't just felt by the oil and gas companies. It's felt by the lenders, it's felt by the capital providers, and it's also felt by the vendors. I did not put the bankruptcy monitor chart information up here for the service companies, but it is very similar. And the service companies continue to feel quite a bit of pain in the current environment. Most companies and many companies won't file that are struggling at the moment won't file for bankruptcy. They will be able to restructure their obligations and meet their requirements and negotiate challenges that they have outside of the bankruptcy or outside of a legal process. And that's good, but at the same time, it's still, the balance sheets will remain stressed for some time to come. Consolidation is a likely outcome in this process. And one of the things that we've seen this year is consolidation. It needs to occur as companies need to reduce costs, reduce expenses. Consolidation is certainly one way to handle that. And I've put a few notable transactions up here. And one of the things that I think that is a bit notable about what the transactions that have been able to occur this year are that a lot of them have been all stock deals and stock for stock transactions. The reason for that is there is a normal tendency in a down price market, and particularly in a market where you're looking at a vaccine in the near term, a rebound in prices. it's easy for sellers or companies that own assets to just hold off and say, look, I'll put that off to another day, or because they're not getting the price that they want for their properties. So it has been something of a slow. Parts of the A&D market have been a bit slow, but the M&A, the mergers market, has certainly been robust, and from a volume perspective, a total price perspective, this will probably wind up being a pretty big year. It is just simply easier to value two publicly traded stocks and compare those and put those companies together than it is in a private transaction, and that's why the A&D activity is a bit slow, and bid-ask spreads continue to remain wide. But ultimately, buyers will meet sellers' expectations. That always happens, and in time, that too will happen. Something else that's affecting where we are today is the election and what will be the regulatory environment. And I have to say, I don't really know where the current, or I should say, the administration-elect is planning to go. The comments have been made that, look, we want to eliminate fracking. We're going to stop fracking. We're going to not stop fracking. It's been all over the map. I wouldn't focus too much though on fracking. I think fracking is a bit of a lightning rod. Fracking is not something that is going to, that really the government is going to have significant control over, except for possibly on federal lands. It will have an impact, I think, in Western states, potentially with increased regulation there. The regulatory burden in that case you might see as being a bit disproportionate. I think here in Texas, where most development and fracking is being done on private land, it's going to be less of a concern. But I think what it really points to is probably what is an increase in regulation, an increase in regulatory scrutiny, obstacles, and potentially harassing legislation. So it is not, I think, over the next 4 years necessarily going to be a particularly friendly regulatory environment for oil and gas producers. And primarily, again, that focus is probably going to be environmental. That is going to be the drumbeat that the industry will hear. So where are we? We have a demand-driven price as a result of a global pandemic. Companies are stressed and in many cases carrying more leverage than they should, and many are going through a bankruptcy or a restructuring process. Valuation, there's continuing to be a valuation disconnect between buyers and sellers. Market activity in some parts is very active in the mergers area, but fairly slow has been, at least on the A&D side. And what are the current trends that we're seeing? As a result of the challenges in balance sheets and in oil and gas companies, I think we're seeing restricted capital resources available for the energy business, at least here in the near term. Pressure to live within cash flow, make distributions to investors will continue to be a driving mandate within the industry. Environmental, social, and governance issues, ESG, have and will, before the recent election, were important and driving decisions and that oil and gas companies were making, and they will even continue to more so now, I think, with greater scrutiny from Washington, particularly as it relates to environmental scrutiny. So where does this leave us? I have the benefit of and the pleasure, quite frankly, of working with a very talented team of professionals at Eternal Energy. Primarily, we work with medium-sized and smaller companies, primarily focused on the energy business, and we work with them in a consulting capacity. We work with those companies to help them develop their businesses, find partners, develop their revenue, and commercialize their products and services. We fill skill gaps and frequently help them in their capital raising activities. As I'd mentioned earlier, one of the things that I want to do in doing this, in doing the kind of work that we do with Eternal Energy, one of the things that I get to do is see a number of technologies and companies that represent opportunities in the current market that help us address some of those trends that we're seeing right now in a need for capital efficiency and a need for cost reduction and a need to meet regulatory and environmental demands that are being placed on our businesses. And personally, I feel like it's much easier to swim with the tide than against it. So I wanted to step through a few companies and a few technologies that we have seen recently. The first one's Bluefield Technology. Bluefield provides satellite-based methane leak detection and reporting service. It's a subscription-based service that anyone can buy and contract for the monitoring of their assets, plants, pipelines, and processing equipment. It may be a little bit hard to see here, but after you subscribe to the service, you've got access to information that you subscribe for, including your equipment, your plants, your process equipment. To zoom in on that screen here a little bit, what you see is, and it may be a little hard to see here, but there's some plumes that are represented on this satellite image. Shows you a geographic area where it's occurring. It shows you specifically, it pinpoints the locations and provides you real-time information. This information is updated daily. So this is the type technology, remote sensing, where it's relatively low cost compared to putting monitors and sensors in your own fields, and it's meeting those environmental goals and requirements that we're setting for ourselves in the industry. Interestingly, this is a subscription service. Anyone can subscribe to the service, and your methane leak information has just effectively been democratized. So if anyone or everyone can know what your methane leaks are, it seems like you should, right? Truly an interesting company and an interesting technology. Second company I'd like to show you is Abyssal SA. Abyssal provides, and Abyssal, but pronounced Abyssal. This is a Portuguese company. Abyssal provides tools for the virtualization and of operational assets and their environment to support remote operations, data augmentation, simulated operations, safety process improvement, and training. This has all come about as a result of the tremendous computing power that we have access to nowadays, and of course the software improvements to be able to handle this as well. This is not just having a digital twin. Don't know how many of you are familiar with digital twins, but basically that's a representation of an asset in digital space. Many companies have turned to and have digital twins, but rather than just having one, it's what do you do with it? And what Abyssal is doing is extending and enhancing the engagement of humans with critical operations, with the critical operation of their assets, and truly an amazing technology. And you're seeing here some of the work that they do. Some of this is simulation that you're seeing right now. What you were seeing previously was augmented reality, giving you additional information about the assets that you're working on and in remote location. And this is a remote location. This is presently what you're seeing is all subsea, deep sea work that they've been doing and is a primary focus for their activity. But this type of work is being done topsides, it's being done terrestrially, and giving companies access, better access to their assets, and reducing cost, improving operational efficiency. A third company is Veros Systems. I'm not going to ask you to read the insert there, but what Veros does is electric waveform analysis for monitoring machinery operation and performance. What is that? They listen to your equipment. All equipment is hooked up to your electrical systems in your plants and your processing equipment, topsides on platforms and production facilities, and it's all runs on power. And Veros listens to the signals that come back through that power system. They provide continuous monitoring and real-time data. And in the end, the interesting thing is they use artificial intelligence to provide predictive analytics around the performance of the equipment and potential failure of the equipment, allowing you time to intervene, to take care of that piece of equipment just in the ordinary course of business. It doesn't have to be an emergency anymore. Also, the benefit of this is you don't have to go place temperature sensors and speed and vibration monitors all over your plant. The technology monitors all of those systems, motors, loads, remotely, giving you remote access to the information in a reduced cost manner. And again, I think you're seeing a theme here. Quite a bit of remote monitoring, remote analysis, computer augmentation, artificial intelligence, which really is machine learning, the way we look at it at this point. In the grand scheme, it reduces costs and expenses for these companies. It's a fraction of the cost of the way that monitoring has been done in the past, and just more effective. And finally, I want to step away here a little bit from the oil and gas supply chain and move over to power for a moment. TS, and to mention a company that I've become familiar with, TS Conductor. TS Conductor has basically taken an old technology and updated it. Conductors are power lines. We see them everywhere. They run behind our house in our neighborhoods. They run across the landscape in large power transmission facilities. And what TS Conductor has done is updated that technology. Right now, the primary technology is a steel core inside that cable wrapped with aluminum wire. The aluminum carrying the electricity and the steel carrying the weight of the cable. TS Conductor has now switched over and started using what they call a carbon core. This is effectively a carbon fiber. It's stronger, it's lighter, it carries more power, or what they refer to as ampacity, and requires no special skills or tools necessarily to install it. And one of the things that they've done, it has been tried before, but they've been able to, in frankly what's a pretty impressive way, overcome some of the drawbacks of conductors, of carbon conductors in the past. And beyond just simply improving the performance characteristics, lighter, carries more capacity, one of the things that this conductor also does is reduces line loss by about 40%. Line loss is that amount of electrical energy that has to be produced at the power station, but that's lost along the way before it gets to your home or to your electrical outlet. Line loss runs 7 or 8% of the power that is generated in this country is just lost to line loss. And given the type of aluminum that they are able to use, given the additional strength of their conductor, they're able to to reduce line loss fairly significantly, and also increase tower spacing. Given that it's lighter, they can space the towers further apart, have a smaller footprint on the environment. Globally, each year, as I mentioned here, line losses represent about 1 billion tons of carbon, and the ability to put even a few percent dent in that will certainly help all of us and meeting our ESG goals. But I've shown you kind of 4 interesting technologies, but there are way more. And one of the things that we get to see are lots of different technologies, and they are all over the place, from cybersecurity to supply chain management, remote renewable power generation, metal loss and corrosion monitoring, advanced coatings and surfacings. You know, an interesting company that we're working with is quality assurance. A program to go in, how are we doing, what are we doing well, what are we not doing well, and what are we doing about those things to improve our performance as a company. Enhanced aiming unit performance, smart casing. There are a lot of technologies that are that are available and are actively making the energy business a better place today. So what I encourage us all to do is, within the context of the environment that we operate, look for the curb cuts and look for the places that are working for you and the ones that aren't. And let's all take advantage of those that are working for us. Thank you. It's been a pleasure. Any questions?
You mentioned the smart casing new technology. Can you describe that?
The smart casing technology is interesting. It is effectively where a technology has been developed to attach wire to casing before it goes in the hole. The key trick there is the connectors and making sure that the connections work. It is a relatively early stage technology. It's not as far. The 4 technologies that I kind of spent a little time on, all those technologies are ready to go. Those are being used right now, and all of them are moving forward. Some of the companies that we work with are a little bit earlier stage. The smart pipe technology is a bit earlier stage, but I think it's coming. And what it does is it gives you better access to information downhole, control of what's going on downhole as well for oil and gas operators and producers.
Yes, that Bluefield technology looks really interesting. What's the lowest level of methane that can be detected, and how does that compare to drone technology? There's a lot of drone technology coming out that drones can be programmed to fly the same route day after day and detect methane. So how does that compare?
Sure. The information that I have on it at this point is that Bluefield is able to detect about 90% of the leaks. They're not going to detect 100% of them, and the leaks that they don't detect are the smaller leaks. And so, to the extent that those are issues for companies, then that is consideration in terms of choosing that. But they are improving the technology all the time, and it wouldn't surprise me that as they're actually developing a couple of satellites that will be their own proprietary satellites. It wouldn't surprise me at all if they're able to narrow down that the size of the leak that they're able to detect here over the next few years. But certainly there are other technologies that compete with that. Anyone else? Thank you all.